this lecture, we're going to look at the financial reporting for owner's equity. When you look at a balance sheet, you see the resources, which we call assets in accounting. And then you see how we raise the capital to buy those assets. Did we take out loans, which are part of the liabilities of the company, or did we get investors? The investors are included in the stockholders' equity part of the balance sheet. When you look at a loan, we're paying interest. Interest is an expense. We're paying cash. This expense, this cash, goes to bankers. These are outsiders. When you look at stocks instead, we might pay dividends to the stockholders. That is cash leaving, but the cash is leaving to insiders, to the investors, in other words, the owners of the business. Also, dividends are not considered an expense, so they don't reduce the profitability on the income statement. A common stock is a sale of equity ownership to investors. They'll become stockholders. Now, the attractiveness of stock is that the stockholder has a limited liability. What that means is that the most the stockholder can lose is the amount that he or she paid for the stock. So there's a limit on the loss. There's a limit on the liability as far as a legal standpoint too. A stockholder can't be held accountable for illegal activities of the business. But there's no limit on the gain that the stockholder can get. If the stock continually goes up, the stockholder continues to make more and more. For this reason, we say that the stockholder gets to participate in the profitability of the company. One element of a common stock is called the par value of the stock. Now, not all stock has par value. This is a legal value that's placed on the face of the security. It doesn't have any correlation to the market value. The market value of the stock is based on what the potential stockholders on the market are willing to pay, what the buyers and sellers are willing to give and take. The par value is a legal amount that depends on the state of incorporation. Some states require a par value on the stock and some states don't. Compared to common stocks, we have another type of stock called a preferred stock. A preferred stock gets preference in dividend payments. Dividends will go to preferred stockholders first. And they would also get preferential treatment if the assets of the company needed to be distributed. So if the company was being liquidated, then the preferred stockholders get their cut of the assets before the common stockholders. A company uses preferred stocks because it's less riskier than debt. In other words, if the company has a tough year, they don't necessarily have to pay the preferred stockholders if they don't have the ability to do so, whereas with debt they have to. They still have to pay for the loan. Also, preferred stock does not affect the covenant restrictions. One difference between preferred stock and common stock is that a preferred stockholder does not have a vote, whereas a common stockholder does. Preferred stock may or may not be participating in the profits of the company. If it's a participating stock, it's allowed to participate in profits above the dividends that's stipulated on the stock. If it's non-participating, it's only going to get the dividends that are promised on the stock, on the face of the preferred stock. In the first example, we'll look at a preferred stock where each preferred stockholder has an 8% dividend. So it's 8% on the par value, which is $25, and there's 100,000 shares outstanding. So based on that information, what we see is that the preferred dividend holders are going to receive dividends of $200,000 each year. Now that's pretty good for the preferred dividend holders because they're more or less guaranteed that amount every year unless the company is unable to pay dividends. However, what if the company is able to pay a lot more dividends? Maybe they do very, very well. So if the company decides they're going to give $1 million in dividends, we know that $200,000 need to go to the preferred stockholders. That means that the remaining $800,000 or 80% of the dividends go to the common stockholders. Remember, common stockholders have no limit on the amount that they can get. They only limit it in the amount of loss they can take. If a stock is participative, that means that the preferred stock is able to participate in the additional dividends, then they'll get part of that $800,000. However, if a preferred stock is non-participative, that means they won't get any of that $800,000. Instead, they'll be limited to the dividends that they were promised. Now, what if a company can't pay the dividends to preferred stockholders? Well, then it'll depend on if the preferred stock is cumulative or non-cumulative. If it's non-cumulative, that just means they lose out. But if it's cumulative, then they have to make that up later on. So if this preferred stock is cumulative and there's some missed dividends from past years, then they'll make it up in the current year when they do have the ability to pay those dividends. And then the remaining will go to the common stockholders. So preferred stock can be either participating or non-participative. It can be cumulative, meaning if past dividends are missed, then they're going to accumulate and then they'll eventually get paid when the company does have the money to pay the dividends. They can be convertible. And what that means when they're convertible is that they can be changed into common stock so that they can participate in higher dividends in that year when the dividends are much higher than they were expected to be in the past. If a preferred stock is convertible, that means that this stock can be converted into a common stock. And the good part of that is if the company's doing very well and they have a high dividend, then preferred stock can change into common stock, convert into common stock, and get to participate in that very high dividend. And then we have something called mandatory redeemable. If a preferred stock is mandatory redeemable, that means the preferred stock requires a company to retire it at a future date. Sometimes they call this debt disguised as equity. Another vehicle that a company may use is called convertible debt. These are notes or loans that pay interest and can be exchanged for stock at a specified conversion price. Next, we'll look at earnings per share.